a new report by Chain Analysis has highlighted the level of growth in crypto globally. To take us through it all is Lowe from Dacxi, and he joins us now live. Ian, great to have you on. So a new report, tell us more.
Yeah, this has got some really interesting insights in it, which I'd be glad to share. So just by way of background, Chain Analysis is the world's leading crypto monitoring technology. So they capture global transaction data across the globe, and they capture that from both centralized exchanges and decentralized exchanges, including peer-to-peer platforms. So look, they've just released their annual adoption index. What this does is it benchmarks the level of crypto adoption around the world. The headline number in the report indicates that there's been an 880% growth in adoption of crypto year on year, so versus the same period last year. Now, the metric of adoption needs to be understood in this report. So what they do is they quantify crypto adoption at a country level by looking at the value and volumes of crypto transactions, and they calibrate that against wealth per capita. So it's a calibrated figure. And then essentially what they do from there is they adopt a ranking by country expressed as an index between 0 and 1. So with all that in mind, what was interesting about the results were that of the top 20 countries in terms of a crypto adoption, the vast majority of them are emerging markets. So if I just run down the list of the top 10 in order: Vietnam, India, Pakistan, Ukraine, Kenya, Nigeria, Venezuela, United States, and Togo. So that's the top 10. So what we're seeing is that adoption rates, which again is not expressing the number of individuals, but it's more an expression of the value and volume of transactions relative to wealth per capita. That's being driven by emerging markets and largely in what we call peer-to-peer platforms. So this is peer-to-peer versus centralized exchanges. So keeping in mind, centralized exchanges go through an identification process to meet local anti-money laundering regulations, whereas peer-to-peer transactions are completely anonymous. Now, the reason, I think anecdotally that we can confidently say that peer-to-peer transactions are so significant in these emerging markets is probably twofold. First of all, access to centralized exchanges in those markets is very limited. And secondly, I think undoubtedly a lot of the participants in those emerging markets would see crypto, despite its volatility, as a way to preserve their savings given the threat of local currency devaluation. So it's interesting that those emerging markets are really driving the growth in total value expressed as adoption. Australia's not in the top 20. The US slipped from number 6 to number 8. China went from 4 to 13. And one other interesting insight to come out of this is that the small retail transactions, so this is what we might call the everyday investor or trader, they represent over 80% of the total transaction values in the peer-to-peer exchanges. But what was interesting to me was that in the centralized exchanges, where they go through identifying all the users and meet all of those AML, anti-money laundering regulations, the retail transactions represent over 70% of the total value. So whilst there's a lot of institutional participation in the crypto market generally, it means that the retail investors are still really driving the growth in terms of adoption generally. And again, just to put this in context, the actual ownership base across all cryptocurrencies has grown from 106 million at the beginning of this year to over 200 million, 220 million in June of this year. So 880% growth in adoption, and a slightly lower but still very significant multiple in annual growth around the number of individuals that hold cryptocurrency in some form.
Yeah, gosh, they're huge numbers, aren't they, Ian? So where is that growth coming from when it comes to developed nations? I know we're seeing a lot of the top US banks now adopting some form of crypto, whether it be speculation or customer transactions. So where do we go from here in the developed nations?
Well, look, I mean, it's a very good question. Earlier this week, Wells Fargo were the latest major bank to come out and announce that they'd registered a Bitcoin fund with the US regulators. If you think about the company they're now in terms of the banks and institutions with crypto exposure, it's a who's who. Morgan Stanley, Standard Chartered, Citibank, UBS, JP Morgan, BNP Paribas, Goldman Sachs, ING, Barclays. I mean, even Westpac earlier this year had a windfall from their investment in Coinbase, where they took away over half $500 million return from that investment. The proliferation of hedge funds, ETFs, derivatives. Derivatives on Binance alone traded to the value of $1.7 trillion just in June. So I think what we can safely say is that cryptocurrency is a ubiquitous part of the financial ecosystem. And why are the larger institutions increasingly participating? The answer is simple. They want to participate in the growth opportunity. They have to participate, not just because they risk missing out if they don't, but their customers increasingly are going to participate with or without them. So they need to be a part of the industry. They need to have positions. I think what's most interesting to us is that as the regulatory frameworks start to develop more rapidly, particularly in the more developed markets or the more sophisticated markets like the US and others, is that the number of institutions and banks that come out with products or funds or various positions in the crypto market, that's going to significantly increase. So even though we're already in a position where really large institutions are all participating, the way in which they participate is going to build significantly as regulatory frameworks develop.
Ian, great to check in with you this afternoon. Thanks so much for joining us.
Good to talk to you.